Anthony is away at the moment, and our special guest is Simon Marcotte, who has been involved in a variety of companies, Arena, and he's with lithium, Gold, Northern Superior, which has just been sold to I Am Gold. Stop me if I'm wrong here, Simon. And also, he was one of the first out of the gate with the big thesis on gold. We did a previous interview with him where saying this is no ordinary bull market, and gold could even hit $30,000. So we're getting an update on that today. Simon,
Well, good to be with you again, Christian. Hope things are well. Always a pleasure to be on.
always a pleasure.
Uh, and I'm assuming you're getting busy because this market is not only lifting gold now, it's lifting every commodities, and I think we're just at the beginning of it. I mean, if you're okay with it, I'd like to
Yeah,
share my screen here
let's
so
get
that
started. How
yeah.
high is this thing going to go?
Well, it's never easy to call the exact level and the exact timeline of things. Having said that, what I like to do here is to point out at, what is it that I'm looking at, and to try to understand what's going on here. So let me just dive into it, Christian. I'll try to bulldoze through the slides, and after that, if we still have a bit of time, I'm happy to do a bit of a Q&A. Having said that, if there's any question you have on the way, don't hesitate to interrupt as well.
Sounds good.
Um, so first, we've seen quite a bit of volatility, and get used to it, right? When people are making that much money, even if I still think we're in the infancy of this market, people are starting to be in the money now. So when there's reason to sell, people are quick to trigger. So I jokingly say that a bull market is called a bull market for a reason. It's going to shake you off its back, and very often, what's the most difficult thing to do is to do nothing and keep on the trade. So today I'd like to discuss a few points. First, the nomination of Kevin Warsh, right? When this was announced, it caused a quite significant pullback in the gold price and in the gold stock. So I want to review Kevin Warsh and the implication of that nomination. Number two, I want to discuss this big debt refinancing wall that we have to go through in 2026. Because all else being equal, as we say, I think this could get gold to actually accelerate in 2026. Also, a bit less of a scientific discussion, but what to expect for the rest of the decade. Investment thesis seem to match the decades, right? And if gold ends up being the thesis of this decade, then by definition, it would end up being a bigger trade than AI has been thus far. And Christian, again, if we still have time, I'd love to review my thoughts here on I am Gold.
Absolutely.
So first, I'd like to always take a bit of a step back. We now have a debt problem. All advanced economies now have a debt problem, which was not the case up to recently. But if we take a step back and really understand the world right now, we had capitalism, which by definition was the reinvestment of capital. This, after we got up the gold standard, morphed into an economy that was driven by credit expansion. Then credit expansion needed globalization in order to keep inflation down. And that worked for quite some time. But eventually, this credit expansion led to wealth inequality. And this wealth inequality created social friction, which led to pretty drastic political changes. We always discuss the political changes of the U.S., but it is really on a global scale. It's really not only in the U.S. And because of those political changes, now globalization is in reverse. So globalization being in reverse, then inflation is back. And inflation is back now. Obviously, higher rates are back and probably here to stay. So because the rates are higher, well, then debt is now more expensive, and now we have a debt problem. So, all in all, countries everywhere are going broke. A new system is needed. I'm not saying it's going to happen tomorrow morning, but a new system is on the way, and a new system will definitely come after we're done experiencing this currency crash, which we're just beginning. Ray Dalio, who you know, the founder of Bridgewater, has been doing the rounds recently, discussing his new book, which is called How Countries Go Broke. And it's a very nice work. But what I take from this book is that, very important point is to conceptualize two of the many phases he does discuss, but two key phases are important for our current positioning. Phase one started in 2008. The economy entered a new phase where the government needed to print money, and that money was used to buy bonds and financial assets and other lower yields in order to support the economy. I think we're all familiar with that. But when the Fed is buying bonds, and does QE in the gold sector, we're always, jumping up and down. And then we realize that it's a very short-term euphoria because really when the Fed is buying bonds, it doesn't really matter if it prints money to do that. It's really good for financial assets. So everybody is running after those financial assets, and it really does little to help the price of hard assets, at least not in the near term. And according to Ray Dalio, we were in this phase until 2020. This new phase was triggered by COVID, if you may. But this phase one will work until it doesn't. So then enters the next phase. In the next phase, then both large deficits and money printing are required to support the economy. So the Fed prints money, which ends up directly into the hands of the people who need it via large deficits. And as the money goes to Main Street, then it is good for hard assets and less for financial assets. And the best example you can think of was those COVID checks, right? And gold stocks did very, very well at that time. Ray Dalio even suggests that the Fed should coordinate with the Treasury Department in that phase. And Kevin Warsh is already discussing this. He's discussing coordinating to Treasury Department with the Fed, which is a form of yield curve control if you think of it. If the government needs X amount of money, and at the same time the Fed is printing and buying the exact same amount of money, then it's de facto a yield curve control, which is obviously very positive for gold. And Kevin Warsh is also discussing that the Fed should stop buying bonds and buy short-term treasuries, which would get the curve to steepen even further, which, as we have experienced, is very good for gold. And listen, the Fed to coordinate with the Treasury Department is very controversial, but frankly, I don't disagree. If this is where we are at, well, then it may be what we need. So I don't really, disagree with what is happening right now. Um, Now, the other point that Mr. Dalio indicates is that the long-term cycle will tip over very, very shortly, and that will be triggered by the short-term business cycle that will tip over. So, this phase two, which is good for hard assets, that gets money directly into the hands of people, will accelerate when the current business cycle will slow down. And he believes we are about two-thirds in this short-term cycle. And I would argue we may be there sooner than he believes. We saw the huge job revisions, all right, in February for 2025. In 2025, you had less than 200,000 jobs that were created versus nearly 1.5 million jobs in 2024. This is starting to be worrisome. I mean, January looked a little bit better, but in the grand scheme of things are slowing down. And let's keep in mind one thing, right, is that so far the economy, everybody thought that a recession would come with higher rates, and the economy avoided a recession. One of the key reason why is because the corporate world had a very low level of debt. Government really stepped in with a higher level of debt, but the corporate world didn't have much debt, so higher rates didn't slow them down. But now the debt is piling in really, really quickly in the corporate world, and that's being led by the hyperscaler. So either we're going to have a recession, or the hyperscaler knows something we don't, and we're going to see rates a lot lower. Let's see what happens in the next in the months ahead. Now, Kevin Warsh, his nomination triggered a gold sell-off, right? Well, I will say this, expecting Kevin Warsh to shrink the balance sheet, as he says he wants to do, is like hoping that Doge will cut the deficit by 2 trillion. I don't think anybody believes it. Gold sold off, but why? Because gold has never been really correlated with the Fed's balance sheet since 2008. What has been correlated with the Fed's balance sheet, especially since 2008, has been the S&P 500, and the S&P didn't move much on that announcement. So whatever the reason was for this big gold pullback we had on that day, I think it's psychological at best. And we can read what the worst can be, but I don't think it was really the fundamental reason was not Kevin Warsh's nomination. And really, the fact that gold is already stabilizing around the $5,000 level is hugely bullish. I mean, we could have pulled back to less than $3,000 an ounce and still be above the 200 days moving average. So quickly here, who is Kevin Warsh, right? Well, Kevin Warsh, he was the counterweight to Ben Bernanke during the 2008 crisis. He thought QE would cause inflation. Obviously, now that it was proven, that has been proven incorrect. I'm sure you have seen the interview that he did not long ago on Fox News. His narrative is pretty clear that he is a Trump loyalist. Um, we've been in a world now that when Republicans are not in power, their narrative is all about the deficit, but when they are in power, we know that they explode the deficit. Well, now it looks like we may have a Fed that is acting the same way. There's some, you can see on the right the narrative of Kevin Warsh himself. He really seems to be dovish under Republicans and hawkish under Democratic presidents. So we now have something a bit more, aligned with the government now, which, like I said, I'm not necessarily against this fundamental change. But let's look into what this could mean. I mean, Kevin Warsh is the son-in-law of the billionaire Ron Lauder. Ron Lauder is a very close relationship, long-term relationship of President Trump. He made an important contribution to his campaigns, as you probably know. To point out to his influence, it is Mr. Lauder who suggested that the U.S. should buy Greenland, and we saw what President Trump did with this idea. I also saw that Ron Lauder has been making speeches at the Heritage Foundation, which is the entity that wrote the famous Project 2025 document. And Project 2025 has a chapter on the Federal Reserve, Chapter 24. And the person who wrote that chapter is Mr. Paul Winfrey. And Mr. Winfrey publicly advocated for Kevin Warsh to be appointed as Fed chair. So when I first pointed out, when I first talked about gold going a lot higher, I reviewed two documents. The first one was the famous document now that was published by Stephen Martin, and now everybody knows Stephen Martin. He's on the board of the Fed. And I think now we need to pay more attention to this Chapter 24 of Project 2025, which has to do with the Federal Reserve. Just further evidence that this is aligned. When Kevin Warsh was on a Fox News interview, his main thing is to say that the Fed has been helping Wall Street buying financial assets. Now it needs to divest of that and deploy capital into Main Street. And really, it's a lot of the same narrative that comes out of Project 2025. And I'm just going to switch really to the last point here. Overall, and I'll review this a little bit more, but Project 2025 is all about getting monetary policies into the hands of the federal government. Now, Project 2025, it reviews the possible systems that could where our system could evolve into, right? From credit expansion that's causing some friction, what it could morph into. It does discuss a lot of the possibilities, but it doesn't make a formal recommendation. I mean, it talks about, just on the first bullet point here, having no Fed, which I don't think is the way to go because we have a lot of debt in the system. You don't want asset prices to crumble. It talks about going into a straight gold standard, which carries the same type of issues. The K% rule is simply a predetermined growth rate for the money supply, but then governments can change that growth rate as they need it. But although they seem to favor this K% rule, they obviously do discuss inflation targeting system, which is the current system, and they discuss inflation and growth targeting, which I don't think works. Inflation and growth targeting is simply put instead of the Fed pointing at 2% inflation rate and then trying to adjust the money supply and using their tools to meet that inflation target, it looks at inflation and growth. So let's say that the economy grows at 3% and 2% inflation. So they would target a 5% inflation and growth. But then you really open the door if you use that. You open the door to stagflation, right? If you enter a recession and you have -3 economic growth, then that means that the Fed would target an 8% inflation. That's stagflation. Doesn't get you anywhere that you want to be. So they seem to prefer the K% rule, but their main recommendation is really for having the Fed to focus only on inflation and let government spending mitigate economic cycles. Again, really putting a lot of more power into the government. Um, so they seem to be dead serious about coming up with a new system, but they don't seem to have a solution, at least yet. And I'm a little bit concerned about the author's understanding of things, the way he discusses inflation targeting, where they write, under inflation targeting, the Fed chooses the inflation target, essentially the highest it thinks the public will accept, and then engineers the money supply. This is not what inflation targeting is. It may be a good, bar conversation, but that's not it. So inflation targeting is to optimize the stability of the market and really to avoid people thinking that you are in deflation. So you can't have zero, you can't target zero, and then 2% has been identified as the optimal point. Anyway, so we'll see where the world goes, but we can't say we don't live in interesting times. Kevin Warsh also, in another interview that he did at the Reagan Foundation, says that we are now starting a new 45-year cycle. Well, I found this chart online, as simple as it may be, where you have a 45-year cycle between 1990 and 2025. And now you can see that this Dow to gold ratio of Mr. Pierre Lassonde is just starting to break down. So we may be in for quite a ride, being exposed to hard assets here for the years ahead. Now, I want to dive a little bit into what is in store here for the rest of 2026. As you know, like close to 10 trillion, so nearly a third of the US debt needs to be refinanced in 2026. And more important is how debt is being refinanced, because I think that's one of the key reasons why gold has been taken off in the past 18 months. So hedge funds, as you know, are now buying a lot of the new debt being issued by the US. So again, let's take a quick step out here. In recent decades, especially starting around 2000, when Americans would buy a product from Asia, pretty much every Asian countries, but let's call it China because that's obviously the biggest country in Asia. Americans would buy a product from China. Normally, this would put upward pressure on a Chinese currency. But then, as you know, China was printing its own currency. and buying the US dollar that was coming in order to keep their currency stable. So then China had this US dollar, and in order to earn a yield on that dollar, it would simply buy treasuries, right? So simply put, the more the United States would import from China, the more easily the United States could finance a large deficit. But now that America buys less from China, following the tariffs, then China, by definition, buys less treasury. So this opened the door for hedge funds to fill the gap. And hedge funds have been filling the gap via what we call the basis trade. So what is the basis trade? I think it's one of the key reasons why gold's been started to perform well. The basis trade, there's a staff paper, as we call it, published by the Fed in October 2025 that estimates that the Cayman-based hedge funds hold now nearly 2 trillion of treasuries. And if that's right, then it's more than any other foreign countries. So hedge funds, the basis trade is that they buy cash treasuries. They put their own money, but then they leverage their own money by taking money from the repo market, which is extremely liquid, and then they don't take a big risk because they then short the futures of the same treasuries. So this would explain why you had a big ramp up in short positions in treasuries, as you can see on the right. Now, the basis trade is not new. It was invented, I think, in the 80s. It started to be used in the 90s, but it really exploded in recent years. And especially after 2022, 2023, the volumes are getting quite impressive. So what's the consequence of the basis trade? It's steepening the curve, right? And a curve that is steepening can be good for gold or can be bad for gold. And well, a curve that is steepening can be bad for gold if it's because the economy is growing very, very fast, companies are making bigger earnings, and the market is pricing in the Fed stepping in to cool off the economy at the right time. This is a situation where the Fed has a lot of credibility that is not good for gold. This is not what we're seeing now. What we're seeing now is basically financial repression. It is really the low end of the curve that is being pushed down, and eventually, I think we're going to see yield curve control on the long end. So this is financial repression, and this is a curve steepening that is very, very good for gold. And again, everything else being equal, if I'm right about those hedge funds, then this steepening of the curve could accelerate in 2026 just because of the amount of money that needs to be refinanced. So, and Kevin Warsh discussing the Fed moving away from buying bonds to buying short-term treasury would definitely go into the same way. So, this is why I think that 2026 gold could accelerate. So another point to keep in mind is that another impact of the basis trade is that it amplifies instability, right? So if the repo market is experiencing volatility as it did in 2020, then hedge funds start unwinding those positions. I will say don't expect another repo crisis. The Fed is probably watching the repo market every 5 minutes. And I think this is why we have seen, surprisingly low VIX, surprisingly low volatility in these markets, surprisingly low corporate spreads. I think it's because the market now understands that there's a constant Fed put that is present in those markets. Also, in recent years, we have observed that the repo market sees a surge in volatility following geopolitical events, meaning that the consequence of that is that gold could more and more react to geopolitical events, interestingly, as it was the case in the 70s. Now, I don't have much interest into discussing US politics. You can just turn on your TV and watch what's going on. But we need, I think, to start getting prepared to things that we couldn't think possible. I wouldn't be surprised, for example, if in 2029 the chairman of the RNC and not the president of the United States occupies the White House. How credit markets would react to such a situation. I think you would see a lot of bonds being sold by Europe and acquired by Middle Eastern investors. Who knows? But that's just one example of what is in front of us. Clearly, this volatility pressure is not going to go away. And remember, China a few years ago suggested to its population that people should be buying gold. Well, now China is urging banks to curb exposure to U.S. Treasuries. So if they end up being right, then this could have a big impact not only on the U.S. bond market, but on the credit expansion itself, right? I also like to point out that this time is different. I believe this time is different. Put things simple, we see a stock market crash, give or take, every 10 years for different reasons, but we see a currency crash every 100 years, every 200 years. And I think we're now, what we're facing is a currency crash. That's why people are always, surprised that everything keeps moving higher. Well, it's because the currency is crashing. And people, never have more than one currency crash in their lifetime. So they're never really prepared for it. Um, so, not only everything will keep moving up, as it is the currencies that are going down, but I always like to point out that the Fed can't let this bubble of everything burst, right? Because all previous bubbles, when they were bursting, were largely offset by the start of the next investment theme, the start of the next bubble. But we've been now in this bubble of everything for quite some time. And by definition, if the bubble of everything bursts, there's nothing left. It's not the gold sector that's going to maintain the entire economy. So I don't think the Fed can let the equity market crash. I mean, we're seeing a big defensive rotation right now within the equity market, which tends to lead or to be an indicator of a bearish equity market. I don't think we can afford to enter a bear market in equity right now. So just jumping in into this decade that we are in, I think gold, and again, there's nothing scientific about this, but for some reason, every big investment theme seems to coincide with the beginning and the end of the decade. Now, there's been one disruptor of this, and it's been semiconductors, and the semis have broken this tradition and performed way longer than the typical decade. But the equity market is now, like I said, experiencing a cyclical rotation to defensive stock. If this changes, well, and things roll into gold, then, I wouldn't discount the possibility that gold and not AI ends up being the biggest investment theme of the decade. So obviously, a lot of stock, a lot of performance in front of us if that's to be the case. You've seen those charts before. How much upside do we really have? Well, on the left, that's Bank of America. That's hard assets versus financial assets. It is the hard assets that need to catch up. There's so much debt in the system that you can't let things deflate. You need to reflate the hard assets from a day-to-day example. A day-to-day example would be, people used to buy their first house at 30 years old. And since COVID, people now buy their first house at 40 years old. And they're pissed off. And they have, young people are not happy about this, and they have the right to be pissed off. So you're not going to solve the problem by getting the price of houses down. That's going to collapse the system. You need people's salary to go up so that they can afford a house at the current price. So the amount of upside on the chart on the left is obviously enormous. On the right chart from our friend Tavi Costa, that's simply the US dollar. You can see two big swing I believe that this swing will be bigger than the other two. And as you can see, we're just at the beginning of this US dollar weakness. And gold stocks remain extremely cheap. And that was the same thing that happened with the oil stocks in the 90s. Oil started to move, but the oil stocks were extremely cheap on a cash flow basis because the market didn't believe the oil price. Well, the more the oil stayed high, the more you had a revaluation of the oil equities. And I think the exact same thing is going to happen for gold stocks. So, gold broke out, then silver caught up, and I think the next play will be for the gold equity to play catch up, right? So that is kind of the a few ideas and food for thought for the macro perspective and how I'm thinking of the sector right now. And if you allow me, I'd like to just quickly dive into my thoughts on IM Gold. Like I said, we sold our company to IM Gold because it is, it is the company that we wanted to be involved in. Obviously, it was the key partner for us in the camp, but we saw a lot of upside into their equity, and therefore we thought it was the right thing to exchange our equity for the IM Gold equity. Now, I'm not, I don't think or I don't expect that Iron Gold will be acquired right away or in the immediate term. I think it's better than this. I think that you're going to see a re-rate before anything happens. And when it comes to gold equity, I think we're moving from, a time where gold stocks were valued on a price to NAV or price to NPV to a cash flow multiple and to be priced as growth stock. And that this has implications. Now, most of the value of, and I'll come back as to why, most of the value of IAM Gold is obviously in the Côté Gold mine in Ontario. IAM Gold is not getting the full value for Essakane simply because it is in Africa. Um, well, I Am Gold announced a share buyback, right? So it looks like they are using the cash flow from Essakane to buy back shares. So people always say that, the equities, the gold equities, don't reflect the full gold price. Well, this is a perfect example of how you make it happen. I think it's a brilliant strategy from IM Gold because they take cash flow that they get from the current gold price at Essakane, turn around and buy back shares. So I think that this will lead IM Gold to outperform its peers on a cash flow basis. And you know what? If IM Gold does not revalue more than its peers over the next little while, then I wouldn't be surprised if they decide to divest of Essakane and then become a Canadian only company, which then definitely would carry a takeover premium in its valuation. So I think the next 12 to 24 months for IM Gold is going to be very interesting here. Um, Now, I said that Côté Gold is the most strategic gold mine in the world. And here's why I believe that. Canada is, for many reasons that you're aware of, probably the only advanced country whose currency has underperformed the US dollar. So if there's anywhere on the planet right now where you want to be producing gold, it's Canada. And Agnico Eagle obviously almost completely controls Canada. Agnico Eagle has the best equity paper that there is in the sector, probably along with Gold Fields. And I would argue that Agnico has this premium paper. Obviously, they are an extremely well managed company, don't get me wrong. But I have to believe that the fact that Agnico control the Canada, the gold industry in Canada has a lot to do with the fact that they have the best paper out there. Agnico owns six of the seven largest gold mines in Canada. And you can see on the right, the one they don't own is Côté Gold of IM Gold. So I think Agnico needs to own Côté Gold in order to keep its control over Canada. If Agnico doesn't buy AmGold, obviously someone else could, right? I mean, I can think of Anglo, Kinross, even the Barrick new North American Spinco It could be a suitor. But if you know what I see is that if somebody else acquires I am gold, then immediately, almost immediately, is going to create or is going to increase the labor cost in Canada as people start chasing operators start chasing labor from neighbors. And also the next time a mine like this will come up, will be up for grabs in Canada, then Agnico will face competition. So I think it makes a lot of sense for Agnico to acquire IAMGOLD, but also if I am right and the market is changing from discount to an AV to a cash flow multiple to value gold equities, then Agnico needs long mine lives to perform well on this basis. Well, Agnico has very long mine life at Malartic and a very long mine life at Detour, but the mine lives at the other operations, especially the ones in Northern Ontario, are much shorter. They can grow through the drill bit, don't get me wrong. But if we are really moving to a cash flow multiple growth stock type of valuation, you're going to need to have proven reserves. And I think that acquiring Côté Gold would help that situation. So I think by buying IM Gold, Agnico can ensure that it preserves its premium paper and complete control over Canada. So we'll see what happens. Again, I don't expect that to happen in the short term, but I think ultimately this is what makes sense. So that, my friend, is kind of my overview of things at the moment.
That's fascinating, Simon. I mean, well, an opus on on the present state of gold right there. Um, okay, let's just stick with I am gold for now. I mean, what are the next moves that people should be looking out for? You can stop the presentation, by the way, if you want. I don't think I can do that from my
Sure,
side.
sure.
There we go. Yeah, what should people be looking out for? Kind of news pipeline coming up with I am gold. Obviously, if someone comes along and says they're buying it, that's one thing. But what else is coming up?
Yeah, so there has been a pattern now that has emerged that every time that I am Gold comes up with their quality numbers, the stock goes up because they have been de-risking the Côté Gold operation phenomenally. They have proven to be spectacular operators. Um, Now, it doesn't mean that it's going to happen every quarter. But one thing that will change the street's valuation will be when, because you have Côté Gold, right? And then they're developing Gosselin right next to it. And once Gosselin gets, included with their visibility into the value of Côté, I would expect the target prices of analysts across the board to increase significantly. So I think that this is probably could be the main driver from fundamental basis of the share price in 2026, let alone the buyback and if the price gold goes up, then they just buy back shares on a daily basis. That they've been active at doing that. So that's kind of what I would expect for the year on IM Gold.
And the team, tell us about the team behind I am gold.
Well, the team is led by Mr. Renaud Adam. And Renaud has proven himself to be a spectacular operator. This is not his first gig, right? I mean, if you go back to the chart that I had, all of the largest gold mines in Canada, after everything that Agnico and Côté Gold and everything else that Agnico owns, just below that, you also have Alamos. And that used to be this operation used to be Island Gold used to be Richemont. That was a Renault Adam venture that was sold to Alamos, and now I think is the best performing asset of Alamos. So the team has proven itself to be a spectacular operator. Their timing may have been good as well, but needless to say that they are behind one of the best and most impressive turnaround that we have seen in the space. And now they can't seem to do anything wrong. The stock remains, fairly cheap. It's not fully valued. And considering its strategic aspect, I think it still has a lot of upside.
Okay, so now yeah, let's okay, just to move back to your kind of thesis here. Gold mining stocks have not moved at the scale that the gold price has moved. Not yet. I mean, they've moved up obviously, but so what do you think will be the tipping point for that?
That, I mean, I think it's the most important driver, I think, is time, right? Because every day that passes, you can't argue with cash flow. Every day that passes, those companies have more money. Every day that passes, you see more M&A. Every day that passes, is a day that you don't have gold, selling off below 3,000. And then people go, you see, I knew, right? Every day that passes, brings somebody else to wonder what's going on here and understanding the type of cycle that we're in. And the more gold stays where it is, more people can use higher gold price and the way that they value gold stocks. So as simple as it may be, I think the more time passes, the more you have to revalue those gold stocks to the upside. And again, the exact same thing happened with oil stocks in the 90s. I mean, if you go back to around 1998, I think oil was around $12 a barrel. And any fund manager wouldn't touch these stocks because they were bullish on oil, but they thought oil was not sustainable at 12. And they all thought, well, even if they are cheap on a cash flow multiple, oil is not sustainable at 12. When oil pulls back to $10 a barrel, I will load up because I'm bullish on oil. Well, they never had that window. And not only oil was sustainable at 12, it went to $140. And when I say that gold can go to 30,000, I think it can easily happen within the same time frame that oil went from 12 in 1998 to 140 around 2007, I think. And around I can't remember exactly when really the oil stocks really woke up, but I would say between, 2003, 2005, something like that, you had a huge multiple expansion. And at some point, the oil stocks were paying a premium to the oil price because at that point, it was obvious that gold was going to go to $300,000 and $300 a barrel, right? So the pendulum always swings to both extremes. And I think the same thing will happen to gold.
Okay, to play devil's advocate, what what is the scenario that this doesn't happen? That gold maybe does go back to 3,000 or something. I mean, maybe Warsh comes in and raises rates, or the US dollar starts appreciating. What is it that people should be wary of, maybe that, something's not playing out as, as you hope?
I don't see again, I really don't see a pattern where gold goes back. I mean, you would need to see the US going back to the old playbook. You would need to see the US going, you know what, let's go back to the way things were, which I really don't think is in the cards. Um, I'm more worried about companies not being as aggressive as they should be. We're looking from the outside and we go, okay, companies have more and more cash. They spend a lot of their reserves. They need to replenish reserves. The companies are cheap. It is obvious that large companies will not only merge, but buy the smaller ones. Well, it's easy to say from the outside. When these companies having board meetings, it's easy for those companies to believe that they are right and that they should wait for things to pull back before they do anything. Um, they are being rewarded a lot right now for having been very prudent in the last few cycles, and companies who bought assets when things were very depressed are being rewarded. So it's very easy for them to say, you see, this is how you manage companies. You wait for things to be depressed. And I think the companies that will take this stance will be left behind because we're not going back. This time is different. And I think the companies where they have boardrooms that can be more aggressive will end up winning the day. So companies could reshuffle, right? I mean, like Nico used to be not that big of a company, and now I don't know if I think recently it had the largest market cap of any gold companies in the world. So things do change. So I think that's the main thing. I mean, those companies don't have CIOs internally. A lot of engineers in there that tend to believe that the market's always wrong. So I'm more worried about the micro aspect of the thesis than the macro aspect of the thesis.
Okay, and lastly, Bitcoin, crypto, can that play into this? Can more volatility, more money, a rotation from crypto and Bitcoin? Obviously, Bitcoin's been going down recently, and those players are going to be looking for a space that is similar to what you're suggesting.
Well, I'm like everybody else on crypto. I don't know what it is. And but I'll say this, the crypto world has argued since day one that they were a digital gold. And that has been proving incorrect. The Bitcoin world has demonstrated clearly that it is the absolute, beta, if you want. It is highly correlated to the Nasdaq, and it is currently not doing well. And I always I'm amazed of the progress of Tether, for example. I don't understand what crypto is because nobody does, but we do understand what a stable coin is. And that is quite amazing what is happening there. I mean, Tether did an interview, right? Or an interview or a presentation with Canaccord a few months ago, and that was amazing, the things that were being said. So they're really starting to accumulate gold. I mean, Tether is buying more gold every month than any other or most central banks. I think one or two central banks may be buying more than them, but they're way, way, way up there, and they're buying a lot of physical gold, and they want to put together a payment system based on a stable coin, completely backed by gold. So that has big, big implications. But again, this is not Bitcoin. This is a new payment system being backed by gold and have a practical way of being able to pay with gold. So that's just a new player that's coming into the space that we did not even discuss, but it's a major, major impact that Tether could have on a gold market.
Simon, wonderful. Thank you very much. I think that's yeah. You hit all the points there. Thank you so much. And as always, always a pleasure.
I'll see you again soon. Thanks for having me on.